Introduction. In the world of finance, the journey through debt management is like navigating a complex and ever-changing landscape. Whether it's governments, corporations, or individuals, the responsibility of managing debt and making timely interest payments forms the foundation of financial health. Let's explore the intricacies of interest payments, debt service, and their far-reaching impacts, while diving into critical financial phenomena like the crowding out effect, the risks of default, and the influence of currency fluctuations.
Where inflation's beginning to fall, the government's
student loan payment pause is going to end.
The mayor launched an amnesty program.
1. The role of interest payments and debt service. Interest payments represent the cost of borrowing, a concept essential for the flow of financial markets and economies. Interest payments are the charges made for borrowing money. Governments, businesses, and individuals alike must pay interest on loans, making it an essential element of financial transactions. For a government issuing bonds, a business expanding with loans, or an individual taking a mortgage, interest payments are the price of using borrowed funds. Debt service includes not only interest payments, but also the repayment of the principal amount, marking the completion of the debt cycle. Effective debt management requires balancing resources between paying debt obligations and continuing essential financial activities. Interest payments and debt service are pillars of financial stability, affecting everything from infrastructure development to daily household expenses. 2. The influence of interest rates and market conditions. Interest rates are shaped by creditworthiness, economic conditions, and central bank policies, making them critical to the cost of borrowing. Interest rates are not static. They shift based on the perceived risk of lending, market supply and demand, and broader economic conditions. The higher the risk a borrower presents, the higher the interest rate they'll pay, increasing the total cost of borrowing. Governments, businesses, and individuals must strategize on how to minimize borrowing costs, whether through refinancing or managing loan terms. Risk-based pricing drives the lending market, reflecting market conditions, borrower reputation, and economic trends. 3. The crowding out effect. Government borrowing versus private investment. When governments borrow heavily, they may inadvertently stifle private sector investments due to rising interest rates. Government borrowing to fund spending on public services or infrastructure may drive interest rates higher, making borrowing more expensive for private businesses and individuals. This rise in interest rates leads to what economists call the crowding out effect, where government spending competes with private investment. Businesses may reduce expansion plans, and individuals may delay major purchases due to higher borrowing costs, which can dampen economic growth. The crowding out effect illustrates the delicate balance between public and private spending, with government borrowing sometimes reducing the space for private sector growth. 4. Managing debt and interest in businesses and households. Businesses and individuals must carefully navigate financing options, balancing debt and growth with long-term financial stability. Companies need to assess whether to finance projects through debt or equity, balancing cost against flexibility and aligning financing strategies with business goals. Similarly, individuals must manage personal debt by choosing appropriate loan types, keeping repayment schedules in check, and avoiding excessive debt accumulation. Mismanaging debt can lead to liquidity crises for businesses and financial strain for individuals, leading to defaults or business failures. Personal and corporate financial health relies on strategic debt management and maintaining a balance between borrowing and growth. 5. The long-term impacts of economic growth on debt. Economic growth is not just about increased production. It involves balancing innovation, demographics, policies, and resource management. Technological advancements often spur economic growth by increasing productivity, but they require significant investment in infrastructure, education, and entrepreneurial support. Government policies, including taxation and fiscal decisions, play a crucial role in creating a conducive environment for long-term growth. Sustained growth depends on careful management of natural resources, particularly as economies shift towards sustainable and renewable sources of energy. Long-term economic growth reflects the complex interplay between innovation, policy, and sustainable resource management. 6. Risk of default and its global consequences. Defaulting on debt has wide-reaching consequences for governments, businesses, and individuals, often leading to economic instability. A government's failure to repay its debts can destabilize its economy, raise borrowing costs, and lead to social unrest. Business defaults disrupt industries, leading to job losses, reduced confidence, and stunted growth. Individuals face personal financial crises, damaging credit scores, and long-lasting repercussions on their financial well-being. The risk of default is a cautionary tale of financial mismanagement, with far-reaching consequences for national economies, global markets, and personal livelihoods. 7. Currency risk in foreign borrowing. Engaging in foreign borrowing introduces currency risk, where fluctuations in exchange rates can increase or decrease debt servicing costs. Borrowing in foreign currencies exposes countries and corporations to fluctuations in exchange rates, which can drastically alter the cost of repaying loans. A sudden depreciation of a borrower's domestic currency can increase the debt burden, forcing them to divert funds from crucial programs or investments. Currency risk is a constant threat in international finance, requiring strategies like hedging and diversification to manage exposure to exchange rate fluctuations. Managing debt, interest payments, and their associated risks is a multifaceted challenge that impacts economies, businesses, and individuals alike. From the complex dynamics of interest rates and debt service to the intricate balance between government spending and private investment, understanding these financial principles is key to maintaining stability and promoting growth. As we navigate the complexities of modern finance, the importance of prudent debt management cannot be overstated, whether for a country, a company, or a household.